Welcome to our panel of International Roundtable. I'm Alex Pollock of AEI, and it's a pleasure to stand in as substitute chairman for this session. It's been my view for a long time that the U.S., being a big country with a very big housing finance and real estate in general market, is nonetheless quite provincial in its thinking and understanding of housing finance, and could greatly benefit by discussions around the world, because real estate and housing in particular, and housing finance, is a big and important sector everywhere. And there are lots of ideas, lots of different regimes. On this panel we have two housing finance systems which are completely different from the U.S., are arguably, at least so far, more successful. And we can certainly learn from the international exchange. Just thinking of the provincialness of the U.S. discussion, not too many years ago, it was very common for people here to run around and say that the United States had the highest home ownership rate in the world. It wasn't true. And in fact, we had then, and have even more now, a more or less middle of the pack home ownership rate, obviously lower now than its artificially expanded rate during the bubble. It was also true that people ran around, especially people who were paid by Fannie Mae and Freddie Mac, saying that the American housing finance system was the envy of the world. Well, if you knew people from the rest of the world, you knew that wasn't true, but they said so anyway. So it's a delight to welcome to this panel representatives from Germany and from Canada, countries which did much better in their housing finance systems than did we during the crisis. Germany did have some notable bank failures, but they were mostly from buying American mortgage-backed securities on a super leveraged basis, which turned out to be a bad idea. And of course, the Europeans had a sovereign debt crisis, but that was different from housing. And Canada, as has been widely discussed, did much better, although I was just talking with Finn, we keep watching this, what looks very much like a Canadian housing bubble, and I'm sure he'll discuss that in his comments. I just came from an international housing finance conference in Europe, the International Union for Housing Finance, an association which was founded 100 years ago, so we were celebrating the 100th anniversary of this international housing finance organization, where we had some very interesting discussions along the lines that we'll have today. As part of preparing for my own remarks there, I looked at the 100-year history of this association and of housing finance in general. But what is most remarkable, if you look at the institutional history, is that 100 years ago and even 50 years ago, housing finance discussions were inseparable from discussions of savings and thrift. The World Manifesto of Housing Finance that the International Union for Housing Finance published in 1935 said, among other things, to every thrifty family its own house. Note the qualification. It's for those who are thrifty. And they used to talk about the mission of savings. The mission of savings. We've lost a good bit of that, and thankfully it's being revived by Ed Pinto in this discussion of the 15-year mortgage, which is really all about forced savings and reviving this old and very sound and solid idea of savings going together with housing finance. Well, we have an excellent panel. We will hear first from Wolfgang Kelbauer, who is from the Association of German Pfandbriefbanken, that is to say covered bond issuing banks, and then Rainer Lux from HIPZERT. The ZERT must be certification, which is a subsidiary of the Covered Bond Association dealing with certification of appraisers. And then from Finn Poschmann, from our think tank cousin in Canada, the C.D. Howe Institute. And each of the panelists will speak, and then we'll let them react to each other or add some clarifying comments, and after that we'll open the floor to your questions, and we will adjourn not later than 5 o'clock punctually. So with that, Wolfgang, you have the floor. Thank you for being with us.
Fine, thank you. Thank you, Alex. Thanks for this nice introduction. I don't need to present you our association. We are basically the largest mortgage providers in the country, in the German market, with a 35% market share in residential and 65% market share in commercial mortgage lending. What I wanted to discuss today is a specific aspect of our business, which is long-term finance. And it is with a strong focus on funding, because funding is basically the backbone of mortgage lending, long-term mortgage lending. And I want to present you some insights of the debate we currently have in Europe, in the European Union, on long-term finance. So my slides are pretty much European and not German, because we have no specific German competence in this area anymore, as banking and lending is a very European issue. We lost any competence on the national level. Everything goes to the European Central Bank, to European supervision. So it became really a European debate. And talking about long-term finance, it's of course very real economy driven. And it is real estate driven, and basically we can scale it down till housing finance, of course. So the first message I wanted to provide you with is the regulatory impact of all those Basel III, Dodd-Frank, European capital requirements directives, all those regulations on long-term finance. There is no comprehensive assessment yet, at least not in the European Union, about the overall impact of the new regulatory framework on banking, on the long-term business. We know the immediate impact was increased capital ratios, which is very good. It was about deleveraging, which might be good, not always. And there is a strong evidence that the new rules are quite detrimental to long-term finance, which is very bad. So I just listed some criteria about on that evidence where the Basel rule introduced additional equity requirements for longer maturities. We know that. There are liquidity coverage ratio rules discouraging investments in less liquid assets. So banks invest a significant percentage of their means into shorter term assets in order to comply with those ratios. Leverage ratio, of course, is driving lenders to deleverage, and the net stable funding ratio also drives banks to have a look on shorter term assets because there's a gap. Longer term funding is not recognized as available stable funding in the shorter maturities. So below 1 year, below 6 months residual maturity, the bank has a problem because there's a gap. So what was the consequence of this? The consequence is that banks tend to lend at shorter maturities. And especially for southern European countries, this produced, the rules produced a credit crunch. The funding of the European economy, the real economy in southern countries, was at risk, or still is at risk. So short-term finance increased, and this triggers, in our view, and I think you have a similar discussion in the US, new liquidity risks, and we are very concerned about this. So 1 year ago, the G20 decided to take this problem on their agenda and to dedicate expert groups to this issue. And the European Union also decided to dedicate research to this and to develop a policy on improving long-term finance of the real economy. So the idea is to look beyond banks and to look for sources of long-term funding from other structures than banks, and to channel long-term finance and long-term fundings from corporates, households, and other institutional investors to long-term financing needs. That is the discussion we are currently having in the European Union. We are quite concerned about this because it puts, or there's a risk that banks, that the traditional long-term lenders, credit institutions, are driven out of the circuit, or might be out of the loop. Because what is in the focus now is insurance companies, pension funds, investment funds, foundations, crowdfunding, and alike. We struggle to remain in the game. That is a huge challenge. There are specific projects like European Union Project Bond Initiative, where the European Investment Bank issues bonds for infrastructure projects, and those bonds would be state guaranteed. And a third area of attention probably will be developing capital markets. So we have mobilizing private non-bank sources, we have project bonds, we have development of capital markets on our agenda, and developing capital markets means reviving securitization and strengthening covered bonds, the two major funding tools for long-term finance. We had intensive debates with the European Union if this is a good idea or not. And basically we could convince the authorities in Brussels that there are some unintended consequences of the regulatory, of the new regulatory framework, and that those unintended consequences, we can even talk about collateral damage to the traditional long-term finance tools, that these damages must be addressed. And authorities, they understand indeed a need to at least assess if the capital requirements are still appropriate for long-term financing, if there is not the one or the other tool or the one or the other ratio which must be reassessed or adapted in order not to penalize long-term finance. And then, of course, we have this maturity transformation debate where there must be a right balance between the flexibility a bank needs to transform maturities, so from funding to lending, and the resilience of the banking sector as a whole. So we think that balance is not in the right balance, and there's a need to reassess this again. And finally, there is a shadow banking aspect, because if you go out of the supervised banking sector into pension funds, investment funds, you are going towards a shadow banking environment where there is a supervisory and a competitive concern that you create uneven level playing fields. And I just quote a figure, 70 trillion of dollars is located outside of the regular banking system, which is so representing 30–40% of all financial assets, and this is a huge figure, and we of course are concerned that we don't lose the balance here. Reviving securitization is one major area on the agenda in Brussels, where we might set up some kind of a prime securitization market composed by less complex, more standardized and transparent ABS. This is pretty much what we discussed some time ago, that there is an initiative called PCS, Prime Collateralized Securities, in order to promote differentiation and standardization of that market, to get that market off again. And it is pretty much driven by preferential regulatory treatment. So that is the immediate goal in Europe, to get a preferential risk weight for PCS securities, and to get PCS securities recognized in all those liquidity buffers, the liquidity coverage ratio of banks. And this would then trigger demand to issue those securities. There is even a discussion to implement a purchase program of the European Central Bank. The ECB announced to buy those securities, and finally there is a debate on public guarantees for those securities. So the ECB is discussing with member states if member states would not provide a public guarantee for those ABSs. The preferential regulatory treatment is very good. A purchase program might add value, but public guarantees for PCS securities, I think, is beyond what we would appreciate from a competitive perspective. So we are a bit reluctant, but we are backing this initiative as such in order to get the market off again. Finally, the covered bond market is also on the agenda. There's a policy, there's a will to strengthen covered bonds. This slide probably is nothing new. Covered bond is an on-balance product. ABS is off balance. We already discussed it. I want to show you a nice landscape about the covered bond markets in Europe. You might know it, but you can see that mostly all European Union member states have national covered bond legislation in place, and even beyond, which is good. It's a nice market, but it's a very diverse market because the legal requirements or the legal baseline is not the same from one country to another. And this is an obstacle for the integration of the market. And this is why we are starting a debate on harmonizing the European framework for this product. If you look outside of Europe, there's a global perspective as many countries beyond the European Union introduced covered bond legislation. Canada, Australia, New Zealand, South Korea, Mexico, Chile is just examples. Brazil announced last month that they will implement a covered bond legislation, and even in the US, I'm not sure, but I have a quote of the American Bankers Association saying that covered bonds would add value to the US housing market and might lead to a more diverse and safer housing finance system. So it's pretty much complementary. This is not at the detriment of sectorization. We conceive both products as complementary, and they work both in the European Union. The overall outstanding of the European covered bond market is about 2.6 trillion euro, compared to the US mortgage-backed securities market. I think it's still a modest size, but it is for our capital market a significant figure, and this shows the potential this funding tool has in the European countries. This is already my last slide, so I think we are on time. I just wanted to summarize the EU proposals to strengthen the funding, this funding tool, which is the covered bond. Policymakers are convinced that the European covered bond market must be further integrated by common standards of safety and robustness. That's the rationale of the product. It is on balance. It is very conservative with LTV limits, with strict eligibility rules, and this should be converged to some kind of a European principles-based rule book, where principles-based rules are applicable across all countries in order to strengthen the product. So supervision is crucial as well. Of course, centralized at European level. We will have 130 banks directly supervised by the European Central Bank. Enforceability of the preferential creditor rights is crucial as well. Segregation of cover pools in the case of bankruptcy of the bank is another pillar of this product. So it makes sense to introduce some common principles on this. One of the challenges within this exercise is to ring fence the instrument against dilution. I talk about dilution. You might not share this view, but dilution stemming from a possible expansion of cover asset types. This means that in Europe, cover assets are restricted to mortgages and public sector lending. You can go beyond this. You can go to credit card loans, to car loans, to SME loans, introducing different cover assets for those types of loans. But then you change the risk profile of the product, and you might have a asset encumbrance problem at the very end. And this is why we are quite reluctant to go beyond a certain limit and a certain safety profile of the cover assets. Because the challenge, what is behind, is the preferential treatment of covered bonds. There is lower risk weights. Covered bonds will be recognized in the liquidity coverage ratio. We have preferential investment rules for insurance companies, for investment companies or investment funds. So all this is at stake, or would be at stake, if we go beyond a certain threshold. That is our debate. From a mortgage lender perspective, we try to remain in the discussions, and we try to direct this debate within the banking supervision and share, of course, experience and funding potential with other funding providers, but it should not be, this debate should not be deviated from the banking sector. This is what I wanted to propose to discuss with you. I don't know if there is a similar discussion in the US, but we are very concerned about the possibility of banks in Europe to provide long-term funding in the future. Thank you.
Thank you, Wolfgang. And as we know, there was legislation introduced in this country for a covered bond statutory framework. It did not move. One of the points of dispute has been exactly your point about how many assets are eligible. That legislation provided for a very wide range of arguably riskier assets. While backing covered bonds, it was my own position that that was a mistake, that it's better to stick to a strictly defined conservative asset base. But we will undoubtedly continue to debate that going forward. Thank you very much. Rainer.
Yeah, thank you very much. Thank you very much for the warm words of welcome, Alex. It's a pleasure and honor to me to speak to you. I think it's a third conference here in Washington for me. My topic today is the German real estate market. There are two reasons for this presentation. Reason one, it's an international conference here, and I wanted to give you an insight to one of the biggest real estate market in the European Union. And the second reason is, after a period of 10, 12 years with a very poor development on the German real estate market, in the last 3, 4, 5 years, there was in some areas some increasing prices and rents. And in the last 12 months, we had a big discussion in Germany. Do we have a bubble on the real estate market in Germany? Bubbles in the United States are tested, like at rating agencies called, and I'm looking forward to the discussion afterwards. I'm general manager of the VDP research, as well as HÜBZERT, where we qualified and certified the values for the German financial industry. My colleague Andreas gave his presentation this morning. And the primary aims of VDP research are doing analysis and forecasts of real estate markets from the view of the German financial industry. We provide all information for the German financial industry, not for the private market. And another thing is to provide actual market information such as rents, prices, capitalization rates, etc., in property for using in property valuation. For example, for my HÜBZERT appraisers, which we certified with HÜBZERT. This picture we have seen this morning, and I have to add two sentences. Andreas told it that we collect transaction data, not offer or asking prices. And the challenge was to do this in line with a very, very strong German data protection law. But we survived this hard work and convinced the banks to deliver us this information. And we do the analysis and we got from them the true treasury, because the transaction data in Germany is a very hot topic. And that is the reason that most of our competitors work with asking prices, but asking prices are asking prices and not transaction data. And the real world is the transaction data. Another reason is that the Financial Supervisory Board accept only transaction data, and that is sometimes a dilemma for some banks. We got the information from around 250 banks. On the one side, the big banks, which deliver us the information on the commercial for the commercial market, like Deutsche Bank, like Hypothekenbank Frankfurt, Bayerische Bank, Berlin Hyp, Hypo Vereinsbank and Münchner Hypothekenbank, Arealbank, and on the other side from around 250 corporate banks, and they deliver us mostly the information about the rural areas. One of our services or product is VDP indices for residential and the commercial markets. That's on the one side the single family index and the condominium index, which is owner-occupied index. Then the rent index and the cap rate index for the multifamily houses, both together as a residential. And on the commercial market, we provide information with the rent index and cap rate index. And the same we do for the retail market, and offices and retail is a commercial, and we finalize this index family in the spring of this year. Of course, we do have some competitors in Germany, but they are not really competitors. Why? One reason I mentioned before, we are the only organization which deals with real transaction data. They do it with offers prices, and most of them deals with the residential indices, but we fulfill the market also with the commercial index. All these, the analysis we do with a so-called hedonic model for the nerves in the room. Here is a formula. My colleague Andreas described the general idea of the hedonic model. That means it's not necessary to talk to you about the same. Here for the income approach and for the index construction, so that I can go to the next chart. You can see the development of the German residential market starting in the year 2003 with 100. Between 2003 and 2009, a poor development. And since 2010, 2011, a slight increasing of these prices, the same also for the owner-occupied houses. And yeah, what are the reasons? What are the reasons of the increasement? On the one side, I think the population growth. I mentioned it last year in my presentation too, and this morning also, that we expected a population which decrease. And but the situation is that especially in the last 3 or 4 years, we had a lot of immigrants from the European part of Europe. That means the southern part of Europe. That means especially the Greece, the Italian, the Spanish young people came to Germany to find works. And what do? They move into the core cities in the metropolitan area like Munich, Berlin, Hamburg, and Frankfurt. And that is the reason that especially in these areas there's an increasement of the population, but you see also a lot of areas where the population is decreasing. On the left side, we see the development of the house prices in Germany, and the white line is the average index for Germany. And you see, of course, in some areas we have increasing prices, but you see also that there are a lot of districts in Germany where the prices decrease, also in the last 5 years. And on the right side, you see the price developments of the condominiums. Of course, the increasement is a little bit higher than at the housing market. And as I mentioned before, it's especially in Munich, Hamburg, and Berlin, the prices increase around 25% in the last 5 years. But you see also in the condominiums market that there are a lot of districts where the prices decrease. Yeah, what is a bubble? And one point is to look to you, and on these slides we see the house price index in Germany and the Case-Shiller composite for the United States. And yeah, I don't see a real bubble in Germany, and I hope you can agree to me. But what is the danger if everybody is discussing about a bubble? It's very dangerous, because if the World Bank or the International Monetary Fund, for example, would told that we do have a bubble in Germany, it maybe takes not 1 week and all the international investors are out of Germany. And that could be a problem, and that is the reason that we also give this information to the World Bank, to the International Monetary Fund, to see that there is no bubble in Germany. Of course, we had a small increasement in some specific area, but the whole market is not in danger. There's no call for alarm, no bubble inside. And once again, the reason is population growth. We expected that the population will fall and it increase in the last 3 years, but that is not a general trend. This trend can be finished if the economy in Italy, in Spain, and in Portugal becomes better. The people will go back to their family, and the population will fall as predicted. On the other side, that was on the demand on the other side, and that was also information Andreas gives for the Berlin market, and we do have the same situation in Germany, in whole of Germany. The construction activities falls because we expected a falling number of population. At the moment, in the last years, we do have under 200,000 new buildings, In Berlin, we heard this morning 5,000 buildings, and that is, of course, not enough for this situation. This picture gives us a good overview about the regional differences in price changes between 2007 and 2013. On the left side, the condominiums, and we see the blue one. We have the price changes for more than minus 4%, and the red one is plus and more than 15%. Where are the red areas? It's a metropolitan area like Munich, Stuttgart, Frankfurt, Cologne, and Hamburg and Munich. But you see also a lot of areas with blue colored, which means less than minus 4%. And on the right side, with a single family house market, more or less the quiet pictures. Coming to the summary, we have high prices increases in core cities, especially in the metropolitan areas. These core cities are characterized by shortage of supply, and those the price increases are a result of a competitive market. The demand is concentrated on exciting housing stock. Extrusion of the market is for cheaper living space, and the construction activities is growing slowly, but still on a low level. Especially core cities are affected because there are in need for multi-family houses. One example we have heard for Berlin this morning. I will go to one of the last pictures, the reasons for what are the reasons for the price developments. I spoke about the demand, the demographic trends, and the household income. I spoke about the supply, about the construction activities, and now I come to the financing conditions, about the financing structure. The VDP organized every 3 years data collection among the member banks, and we have a sample size in 2012 of 736 transactions of owner-occupied family houses. And what are the results? The result is that the average living area in Germany is for one family houses is 147 square meter. The property value is 279,000 euro. The share of borrowed fund is 71%. That means the customer brings 30% equity with it. The monthly net household income is around 4,100 euro, and the debt burden ratio is 23%, and the house price income ratio overall is 5.7 to 1. And these are the data from 2012. And if you see on the left side, the data for the year 2009, you see there are not big changes. That means there is no different financial culture in Germany. The financial practice for borrowers is very solid. On the next page, we see the residential property financed by income quartile. And also here you see that the share of borrowed funds between 2009 and 2011 don't change very. There are no big changes, And that is what I have learned, and I think also we are in the lessons during the dinner speech from Ed and Susan, we heard one criteria for a bubble is that the financial structure is changing dramatically. And as we can here see, there is no changes. That means there's also no, from my point of view, no sign for a bubble. The next slide, we see the fixed rate period and interest rate. The fixed rate for a period for a smaller 1 year is, for example, 3.5, and longer 10 years is 3.7. At the moment, I think it's between 1.7 and 2.5. And all in all, we can, we can say that the VDP survey reflects the price development in the residential property market. House prices and income ratios rose slightly. The share of borrowed funds declines despite the extremely low mortgage interest rate, and the debt burden ratio decreased a little bit, and the tendency to longer fixed interest rate period and the residential mortgage lending practice do not tend to be riskier over the period from 2009 to 2012. What does it mean? There's no sign for a bubble from my point of view, and there's no call for alarm for any organization in this world. Thank you very much.
Thank you very much. Now we'll move to Canada. Finn.
Thank you, Alex. Thank you, Rainer and Wolfgang. First off, great to see everyone. Second, this isn't my real voice, but a product of some traveling in the past couple of weeks. So I hope everyone can hear me. I'll work on it. This is going to be fun. Just to give you an overview, I'm going to look at market structure and recent changes, legislative and regulatory changes in it. Two, then switch to some national, regional, and local price trends, and that's what my slides will be about. And three, some speculation on sources and nature of risk. It will mostly be speculation. One of the reasons for it is that we don't have a lot of data in Canada. Certainly nothing like the loan level data that Ed and others and Alex have assembled here, and not even as much as our other NATO allies sitting to my right have with respect to access to data. So I'll talk about some of the structural sources of risk rather than the loan level or collateral risk, but I will touch on all of that. First, on market structure, I've assumed in the past in talking to U.S. audiences, there we go, that Americans and others were generally familiar with the Canadian housing finance structure. This assumption has proved profoundly wrong, so I'm going to spend some time with that.
I mentioned our provincial approach.
So here's the picture. Canada's population is about 36 million, 14 million households. So that makes it about the size of California. Of course, this is spread over a country that's rather bigger than the U.S. Do not, though, let that distract you. It is predominantly an urban and suburban population, and not many people live in the rural areas, and there's nothing like the cities you see across the interstates here in New York and Pennsylvania and elsewhere. So it's very much an urban and a suburban population. From the housing perspective, housing finance perspective, banks are the primary mortgage lenders. If you go back to the 1960s, they weren't even in the business. Now the chartered banks in Canada dominate that business, followed by the life cos and then a few other monolines and others. There is also in Quebec what's called a caisse populaire, and elsewhere in Canada, a credit union, a significant credit union segment. So this is more or less the equivalent of the U.S. savings and loan segment. There are a small number of large banks in Canada, and by a small number I mean precisely 5. And there's also a small number of smaller banks, and this, at least from a perspective of some of us, makes them a little bit easier to regulate at the federal level. And there are some other implications which I may have a chance to mention. Now, with respect to consumer lending and mortgage lending, a few things, and one is that the 30-year mortgage, you can find them, but it really doesn't exist. The most typical mortgage that Canadians tend to buy or borrow is a 5-year closed mortgage, and it may be a fixed rate, may be floating. When the share of the floating rate market gets a little high, that makes regulators and the bankers themselves a little bit nervous. And a lot of people come in at the much, much shorter end of the range. In other words, 6 month, 1 month, or 6 month, 1 year, 2 or 3 year terms. And there, some interesting stuff kind of flows from this. One is the common, irrespective of the term of the mortgage, the common amortization period is 25 years, and the mortgage is renewed on a regular basis. Almost all of the mortgages are closed in the sense that there is a hefty prepayment penalty. So interest rates have to come down a lot and quickly before you tend to see consumers doing refinancings. You can buy short-term, and people do buy short-term open loans, which means no prepayment penalty. But their posted rates are probably going to be about 2 percentage points higher than similar term closed loans. So that gives you an indication of the size of the pre-penalty, and 2, who's going to pay it, which is the borrower. So one of the impacts of this, of course, is that the Canadian bankers do not like to take risk, and when they do extend risk, they're going to ask the consumer to pay for it. There is a small number of banks, as I mentioned, and quarter after quarter after quarter after year, their ROE is coming in at 14 to 20%. So they're really very stable and well capitalized, and very widely held in terms of shareholdings. Home ownership rate is the same as the U.S. generally, has been for a very long time. If you look at the history, I'd say slightly less volatile. I haven't run the numbers to do it, but if you just look at a picture, the home ownership rate looks less volatile. Houses in square footage terms tend to be smaller than in the U.S., and they're also more likely to be owned without a mortgage, generally. And my assertion, I've seen little evidence on this, is that other than the observations that I just made, is that that's because there's no mortgage interest deductibility in Canada. Every once in a while, realtors promote it, and you might get some support for it in the House. But Treasury and Finance will shoot it down before it gets very far again, because they don't like the giant hole in the tax base. And by the way, when I was researching this years ago, I discovered that the U.S. mortgage interest deductibility rules really are a historical accident, but apparently it's not one that can readily be undone. What else? Mortgage insurance. Okay, this is big business. Any mortgage with less than a 20% down payment that's offered by a federally regulated insurer, or rather a lender and others, must have its mortgage insurance. And mortgage insurance is provided by one of 3 companies. The first and largest, with 70% of the market, is an agency, Crown Financial Corporation. So it is backed by the full faith and credit, AAA of the Government of Canada. So the bonds it issues trade with a maple leaf on it. For reasons known mostly to financial markets, they trade probably at 20 to 40 beeps over actual Government of Canada bonds of similar duration or yield term. The other 30%, well, the 20% of the market is controlled by a publicly traded corporation known as Genworth. This will be familiar to a U.S. audience. However, it is a publicly traded and independent Canadian corporation. And I believe that Genworth in the U.S. still owns some meaningful part of it, but absolutely it's publicly traded. And 10% is an entirely private joint venture. Which, unsurprisingly, it has, so far as we can tell, the best ROE. That's very shrewdly managed. So that's an overview of the mortgage insurance market. There really is only one product. There's an element of risk pricing in it that's based on credit scores, but that's all. It's the same product, whoever supplies it. The private insurers are 90% backed in the case of their failure, backed by the Government of Canada. So that enables their insured mortgages to carry a decent risk weighting when that helps, of course, their funding. So it's still, they're going to be probably, the costs are probably a few $100s over the life of a mortgage extra, because of the higher risk weighting that they have relative to the directly federally insured ones. So we did have a big shock beginning in 2007 in financial markets, then over 2008-9. Preceding that, there had been a strong credit buildup, especially at the Crown Financial lender, and its mortgage insurance book was growing by leaps and bounds. They were insuring 40-year mortgages, and which is probably not a good idea. Now, when it comes to the impact of the financial shock, there was only one significant failure after that when the asset-backed paper market seized in August 2007. There was one Canadian conduit that had $16–17 billion on its books. So it was finally wound up in 2012. But other than that, the Canadian financial institutions weathered the 2008-2009 downturn with some losses, but certainly never any significant risk to their shareholders or lenders. Nonetheless, I talked about the growth, the run-up. So there were structural environmental changes that the government imposed, which we encouraged. So standards were ratcheted up. There's no more mortgage insurance for refis and HELOCs, which there was before. Lowered by regulation, maximum GDS and TDS terms, get a little excited, shortened the maximum allowed amortization period from 40 to 25 years, and generally borrowers will have to qualify at a 5-year posted rate rather than the much shorter term floating rates that many of us choose. Another aspect was administrative restraint. Executed with respect to the Crown mortgage insurer, so limiting the size of its insurance book and limiting the growth of the portfolio insurance that it extended. So many of the banks have been insuring bundles of mortgages. So these are low LTV mortgages, but you pool them together, buy portfolio insurance for the bundle, and that helps you bring down the financing spread a little bit. So our finance department and us, we thought, well, we really don't need so much of that, so it's being restrained as well. Another really fun thing, which a lot of us have been looking for, was effective 2012. 2012 legislation, effective January 2013, covered bond legislation, so that was done. It was done quite quickly and easily. Few interesting aspects of it. The covered bond registry is run by the Crown Agency, and it's going to help give them something to do, especially if we're successful in shrinking their other activities. The legislation for covered bonds has said no insured product. So while covered bonds had been in the marketplace for a while, the legislation has said from henceforward, you're not putting insured product into the covered bonds. Let that market look after itself. And if you want to sell your mortgages in any other form of securitization, you've got to do it through the Crown run mortgage lender, or rather mortgage bond program. So in other words, the Crown's insuring it already, and they don't want to do it again. So the method to the madness is the encouragement of private, non-government-backed funding channels for housing lenders. We'll find out how it goes. There is no private MBS channel to this point. It's the grail that many of us are looking for. We'll get there. 5 minutes, that's absolutely right. But I did want to, so that's the background. So we think we've got this better. We think we've got this better than it was. So I'm going to turn to the regional markets. This is the figure that gives Americans the heebie-jeebies. It's indexed to August 2008, which was the past peak in the Canadian market before the shock. So we're already halfway down the downward ride that the U.S. was going through. The difference, though, in Canada was by the end of 2009, the lost ground was completely made up at a national level. There are a few lingering markets and some that have been in negative territory since. But overall, it's been this steady ratchet upward at the national level. And that's why it becomes sort of important to talk about the regional stuff. So, if you didn't pick up these sheets at lunchtime, or you can't see the screen, it is available on the AEI website. So, regional markets. So I picked Vancouver, Calgary, and Toronto. These three centers cover about 1/3 of resale transactions for Canadian marketplace. Half of the market by transaction value. So they're by far the largest markets. And Calgary, the most volatile of them, arguably. And then in my next figure, I just look at the year-over-year growth rates with Vancouver and Toronto, sort of benchmarked to the U.S. So the U.S., of course, is in blue in my figure, and Toronto in red, and Vancouver somewhere in between. I decided to skip Calgary for that one. So there's at the time of the 2008-2009 shock and then the recovery from it, there is some definite correlation or apparent correlation across markets. Since then, not so much. Now, I want to shift to the regional or sub-regional market. Now, this is Toronto. And this is something that we've only recently been able to do. So this is forward sortation level. So that's sort of think of it as the first few digits of, well, it's a lot like a zip code, something like 1,500 of them across Canada. And I discovered this morning that it was de rigueur for this conference to prepare some heat maps. So I'm glad I thought of doing one last week. So what are we seeing here? What can I tell you about it? The hot zones are sort of north of the University of Toronto. For those of you who know the neighborhood, there's a lot of development and intensification going on there. It's already a very nice place to live, but Toronto has become a condo market, more so than it has been before. And especially on the lakefront, so that the southern edge of this map here you're seeing is the lakefront. So it now looks a lot like South Beach, Miami, sort of skyline-wise. Not so much sand, more concrete for its beach. But it's the numbers are truly remarkable for the increase in the stock over time. And that's the one that people are always asking about. Next one, now I'm going to skip 2 ahead to cover Calgary first. Okay. So Calgary is the one that took the hardest and longest hit, going back to 2007, and it's now come back again. Calgary is we heard a lot of talk about fundamentals. This is oil and gas. Okay, that's what this is about. Hot zones are in Calgary Southwest, where they've really been building out, and as well a little bit northwest and around the core. But it's really driven by oil and gas. And that's where the fun comes in. You can be nervous about Calgary house prices because they have had big crashes. I'm sure many of them are hoping that we can manage a Keystone XL approval. I'm sure that's coming any time. It will have a positive impact. But other risks, and it's fascinating. The risks are oil prices, because the oil prices cruise down below $100. A lot of the oil sands development is totally uneconomic. And this is, so that's interesting by itself. But we've actually had statements from the Bank of Canada that discuss the oil price differential between WTI and the price at which is crossing the border. So it is really a remarkable impact. So it's oil and gas. There are no beaches in Calgary. Now go back to, okay, so Vancouver. So here we are in the far west. Vancouver has a lot of stuff going on. There's inflows and outflows from Asia, especially Hong Kong. That affects things over time. It too is a condo market. In a way that it was not historically, but it's been doing very well for a long time in that field. But the hot zones that you're seeing here is residential. It's west. It's around the University of British Columbia. So what have you got? What have you got there? Well, it's Pacific Coast, big lots. Lots of redwoods. It's really quite nice, and one of the most popular clothing optional beaches there are on the coast, or it would be more popular if it didn't rain so much. So that's the market overview. What are the risks? Well, 1 minute. Okay. Well, we've got hardly any data. I did have, I didn't show the blank page. In a couple of months, at a much finer regional disaggregation, we will have credit market exposure way below the FSA level here, courtesy of credit rating agencies. And we're going to start, we'll be able to build maps that link housing price trends to that credit. It's a long job. It has a lot to do with data access, and we've been playing with it so far. It begins in fourth quarter 2013, so it's going to take some time to build a history on that front for the regional credit market exposure. Another issue, I mentioned the provincially regulated lenders. It's a different beast. Their primary funding channel is deposits. They have an unholy degree of access to deposit insurance. It's unlimited from the Ontario-Manitoba border west, all but unlimited in the eastern provinces. And they're provincially regulated, which means it's really sort of Wild West as far as lending patterns go. But they also, are in the mortgage business and in the insured mortgage business. So there's some fun stuff going on with bringing the credit union sector into federal legislation, but there are a lot of wrinkles to be worked out to deal with that, and one of them is the deposit insurance program. So I don't recommend expanding deposit insurance. I do recommend expanding covered bond insurance or covered bond markets, but don't get the government to back them. So that's where I'll stop.
Thank you. I fully agree with your recommendation. Let me just take a minute with the panel to ask each of you a question based on your remarks. If I may, Wolfgang, you mentioned the efforts to have unified covered bond legislation in Europe. This strikes me as very difficult given the national basis of the laws. What would you say are the one or two biggest obstacles for such common European legislation for covered bonds?
Yeah, indeed, that's a quite technical, a complex approach. The problem is that 28 different legal frameworks, they, from an investor's perspective, might be an obstacle to leverage the market itself, to leverage the product, because the investor has to do a credit risk assessment for each of those 28 if he wants to invest in all 28 covered bond products. So the supervisors tell us in order to set the potential free, what you have in the product, you need to do something. And the idea is harmonization in a sense of convergence of basic principles, because the covered bond product relies on some pillars, and it's 10 pillars, 10 principles, and if you then are successful to harmonize those principles, you can leave the technical level out of the harmonization process. We can have eternal discussions on LTV limits. If it's 60, 65, 70, or 80, that makes not the difference. But that there is a LTV limit is crucial. That there is a conservative valuation process in place is crucial. That asset segregation mechanism are in place is crucial. So if you got those principles fixed, then I think the investors, they don't care about the covered bond investment itself. It's a safe investment, and the differentials which remain translate in spreads. Higher spreads for riskier covered bonds, and this is arbitrage opportunities for investors, and they like that. So they tell us you don't need to implement a full technical harmonization, but we must be sure that if we invest in the market segment, that the pillars are right. That's it.
Thank you. That's very interesting. I think you talked me into there's no German bubble. I think Finn convinced me there is at least a Vancouver beachfront bubble. But we heard this morning about the relatively low level of German home ownership, around 45% or so, which is, let's say, 20% lower than U.S. or Canada or United Kingdom. When you're looking at the price development and the residential market, is this something from a German point of view that you worry about, or are you the home ownership level, or are you happy at, say, 45%? I guess none of us know what optimum is, but how does the level of home ownership come into your thoughts in the development of the market?
Yeah, a rating agency and also the World Bank ask us what is the reason of the low home owner ratioship, and from the question you feel that low home ownership is bad. But what is the situation in Germany? The situation in Germany is that we have a well-running rental market, and it's possible for everybody to rent a flat. And that might be the difference to the United States or the United Kingdom, where you don't have a well-running rental market. And that is one point. And the another point is that is not the reason that we are angry or something like this. It's always a calculation what is easier and cheaper to rent or cheaper to buy. And if you have all these, you have an alternative, you buy or rent. And at the moment, and this change, but in the long term, it must be the same, because if you have a long time where it's better to rent or cheaper to rent, of course the rents will increase, and vice versa.
Please.
May I add, we have been blacklisted by the European Commission of having restricted access to home ownership. And the Commission told us you need to change this. It was 6 years ago, 7 years ago. And since very recently, it is just the other way around. We tell the Commission, you must be very clear on it. Not everybody can afford home ownership, and not everybody can access to ownership. And we must be consequent on this. And policymakers understand this and say, okay, we do not need a policy where everybody can access. If we have a performing rental market, it is as good. So that is the truth.
Thank you. Good point. Finn, you kept mentioning the Crown Corporation. This is CMHC, Canada Mortgage and Housing Corporation. My memory is they have about half of the total mortgage credit risk in Canada. Is that about right? CMHC. And my question is, should we worry? Is there risk in this government corporation, which has a very large part of the total mortgage risk? Are the Canadians yourselves worried about its own financial status?
At this point, much less worried than we would have been a few years ago, owing mostly to the slowing down of the growth of its insurance book. Yeah, it's the numbers you'd mentioned probably be about right. The last time I looked, Canadian chartered banks had fully half of their assets backed directly or indirectly by the government of Canada or through CMHC, and it was that awareness that persuaded overseers to limit it. Yes, and we did a number of things, including changing the board structure of CMHC, bringing in management that had a more market-based perspective, sicking the federal regulator on them for at least an annual inspection. Their financial statements look a little more like what the rest of us would recognize as financial statements, and there's more data flow. So it's certainly much better than it was. There remains, though, no reason for it except for that structure, because you could quite reasonably sell off the whole thing. But you need to manage this right because of the tail risk problem, and that's one. So a fund, you know that the government is always going to linger there in the background. So you want that up front and recognized, because owing to capital flight and that's what we now call fat tails. You do need to figure out how that's going to work before you launch yourself that way.
Good, thank you. When you're looking for bubbles, one way to know it is the so-called tail has developed a probability of 100%. Then you're in a bubble. It's time for questions, and we do have time for a few questions from the audience. So if you'll wait, we have microphones. Okay, and we'll start here. Please identify yourself and your affiliation. Keep your question brief, and we'll see if we can fit a few in. Yes, please.
Hi, Morris Davis, Rutgers. So I have a question for Finn. We talked about this at dinner, but I want to bring it up again. Can you go to the slide comparing the U.S. and Canada? So these are roughly comparable cities because it's the Case-Shiller 20 and the Canada 11. And the graphs, the numbers have been normalized to 100, so they don't look that scary. But if you strip out consumer price inflation, I think the blue line, which is the U.S., implies total cumulative appreciation of 30%. And the red line, which is Canada, over the same time period, implies total cumulative real appreciation of 85%, if I've done my math correctly. So it's 30% US, 85% Canada.
That's why
Isn't
we might
that
be worried
worrisome?
about CMHC.
Doesn't that mean that house prices, and Canada, these are roughly the same cities, and we talk about income being an anchor. Incomes in Canada haven't been that different from the US, except for the financial crisis, but over a 15-year period, probably not that different. So can't prices in Canada fall by a third?
Well, that's a very good question, Morris. I'll preface by saying there's only a couple of stocks that you can buy that are direct shorts on the Canadian market. One of the monoline lenders. Yeah, you don't get to, people have stress tested this and modeled it lots of ways, and you need a labor market hit for a really, really, really long time to produce that kind of price shock. It's not, everything that's happened before will happen again. And yeah, over the past decade, the real price increase has been significant, and this is one of the reasons that regulators in the bank have been concerned about things like consumer debt. So the U.S. consumer debt has retrenched since 2008. Canada's debt-to-income ratio at the consumer level is cruising at an all-time high. But the growth of it has very helpfully tapered. And the other thing is the collateral side, because if you look at debt to assets, then it's not nearly so ugly. And even if you restrict yourself to debt to financial assets, it's not that ugly. So it's, what happens here will be a labor market story. This is how all of the modeling goes. The risk analysis and our friends at CMHC, they will talk about the possibility of an endogenous housing finance market shock, but we don't know enough about that to say anything credible.
Okay, I had another question in the back, was it? If not, we'll come to Ed.
What about an interest rate shock? I mean, it sounds like, given the income issue, an interest rate shock, unexpected but significant, could impact both the resets of the arms and the demand for buying houses on a resale market.
Yeah, so you'd start to run into trouble with, say, a 4% hit. With a 4% hit, in nominal or real interest rates. Yes, yeah, but not at 1 or 2. And this is one of the interesting things for the mortgage insurance, or for the current qualifications, is requiring people to qualify at a higher rate than the likely market rate that they will achieve. And the other thing is ratcheting down the maximum GDS and TDS. For the relatively unregulated sector, that's a little different. Yeah, there are risks, and we hope to know more about them in a couple of years. But of course, you never know that it was a bubble until it's burst.
May put that question to our German colleagues as well. What do the German in particular, but maybe European in general, housing markets have as vulnerability to an increase from the current extremely abnormal low interest rates, say a 3% increase in rates or something? What happens to housing?
There was one chart in my presentation which documented that more than 90% of the loans are fixed rated periods with more than 5 years. That means if the rates changes for these, nothing happened.
Okay, other questions? Right, yes, please. Where's our, hang on, wait for the microphone, please. Right over here. Thank you.
Yeah, as far as your question from Rutgers, in the stress testing scenario, you have to be careful in that in the U.S., remember when they stress tested Fannie and Freddie's portfolio, it was the 5 continuous states that Ed talked about earlier, which was a 13% decline that recovered fully after 5 years. That did not anticipate the complete seizure of the credit markets at the same time. And so that led to peak to trough of over 30% nationally, 50% in places like Nevada. So it's the combination of things coming at you that can really kill you, as opposed to just looking at historical house price trends themselves and even interest rate effects. So you might want to factor that into the kind of stress test that you're doing. It's pretty important.
This is a statement, not a question. Thank you very much.
Yeah, sorry.
No, that's fine. Other questions? Over here, please.
George Mann. This is for, I think, probably for Reiner on slide 16, because he likes bubble questions. So, It has to do with
What-
the multifamily, so be easier to see when it's up there. That one, Reiner. The last 2 years, and with multifamily being, I guess, 55% of the market, the last 2 years looks like rents are going up about 7% a year, which is extreme and compared to since 2003. And I don't know how well incomes are doing. I'm sure well, but I'm not sure that well. Is there any concern about that market being a bubble in Germany?
Yeah, but see the whole picture, and the whole picture is that we don't have no development from 2003 to 2009 or 2011. And for the whole period, it is around 16% in around 10 years. That means 1.6 a year in average. Inflation rate is maybe in the same time 1.5, 1.6. That's nothing. That's really nothing.
Thank
From
you.
my point of view.
Good question, good,
course,
good
yeah.
answer. Other questions? Well, thank you very much. You, by having your questions so well timed, you have gotten us out a few minutes early to start the general Q&A session. Let's thank our excellent panel.
So, don't want to keep you from the cocktail hour too long here, but if you wanted to comment, that would be period to wrap up and pop up any unanswered questions. And so we'll take those now. Any additional questions, George?
With mortgage lending value, as I understand it from reading the Fan Brief Act, I think loan to values are about 50 or 60% of mortgage lending value. Right now, the borrowers and lenders are probably going for market value because it's so much higher. What is the typical range on commercial loans, especially of loan to market value versus what it is on loan to mortgage lending value?
It is pretty much similar to residential values. We apply a 60% LTV to the mortgage lending value for commercial mortgages, which more or less corresponds to a 50% market value of that commercial property. So it is pretty much the same risk profile as in the residential area.
Thanks.
This was excuse me, a general question. We're supposed to ask general questions now.
Yeah, any question, anything that we've covered today, assuming there's someone here to answer it.
So, so I guess one takeaway was the greater. This is just looking at house price volatility locally in general, and it seems pretty clear from Oliner's presentation that the greater the share of land value as a proportion of the home price, the more volatile those
That's
prices.
a greater the change in share.
Yes.
Great.
The greater that's a good forecast, but it was the change, but also the absolute level. You did both, didn't you?
The predictive power was from the change in the share. So when the share rose a lot, that was a risk factor for a subsequent house price decline. It wasn't, the result was not related to the level and the regression, but to the extent that the level matters, the places that had low land price shares to start with in 2000 were the places where land is inexpensive. Its price rose a lot. The land share in those areas rose a lot, and that was an indication that something was awry, because it meant that the house value was rising way, way above the reconstruction cost of the house, and that should set up alarm bells.
So basically, the one chart I keep returning to, and it was from Burns. Is he still here? There was this chart right in the beginning where he shows, it has an arrow on the top. It says market volatility.
Yes.
So it shows volatility going from low to high. But then on the bottom, it has fundamentals, right? So there's an intrinsic, we're trying to like separate what's fundamental and what's just in the price. It has a wide range of fundamental risks, right? It's some of the ones that are really volatile have, he indicates as being very risky. Some of the ones which were low in volatility, he indicates as being very risky. Conversely, some of the ones which were high in volatility, he says weren't risky, and some of the ones which were low in volatility weren't risky.
Right.
So, so I guess and I know you're working on it because it looks like the hedonic price index is the fundamental economic risk factors is what you're working on right now. But it's the thing that's confusing to me is it possible, and why would certain home price areas be more volatile but have less fundamental risks? I mean,
Right. Well, I
is
think
is that even accurate to say? Maybe I'm just led astray by looking at this one chart right from the beginning.
Well, I wish John were here to talk about his chart, but I think the basic thing he's trying to say is that some markets historically have been volatile, but they could still have good fundamentals today. So you have to look at market conditions today as well as what has historically been true.
So, well, I was looking at the Berlin. So the takeaway from the Berlin study, which was when he measured it indirectly in the way that you measured land values, that volatility was greater than when he tried to do it directly. And so I was like, well, why would that be? Like, why would the indirect land value be greater than the direct value, that volatility? And the only thing I could come up with is more of the things that were in the direct were encapsulated in the construction costs rather than in the land. But I mean, I might be
Why don't
misunderstanding,
you let him
but I
answer
wasn't
the
sure why.
question?
Yeah.
Now that
No, I'm thinking that the differences are in the type of measurement. The direct measurement comes from the land values, which are provided by the local real estate governor, surveyor commission. So what they basically do is they measure the land value on a sales comparison approach from house price sales. And they deliver a value which is, in Germany, is official, because this real estate surveyor commission has this semi-official standard, and you have to use it in valuation. And what I try to do is to get all the values and make an index out of it. And but what lies at the heart of this measurement is that is lagging. I think this the direct index is lagging because the information to estimate these values from the local real estate surveyor commissions is lagging 1 year or 2 years behind the real indirect measured land value index. So this is the reason. It's a data error or lagging data.
So we ran into this a bit in the United States. So when we first looked at land values, the tax assessors have land values. Montgomery County has land values. And what we found was, notwithstanding that it's well known that land value shares vary very widely across markets within Montgomery County, the percentages that the county provided on their assessment of how much was land and how much was structure didn't vary very much. It was like they just plugged in a percentage. And that then said, well, wait, that's not very useful. Well, I'm not saying that's what they do in Germany, but those are the kinds of things when you have a government-provided value that may not actually be representing what's going on in the market. To the other point that you had on John's slide, I think he even said on one of the slides that they view Riverside San Bernardino as a favorable market at the moment, even though it's a C. That hasn't moved to the D, but it is clearly one of the most volatile, if not the most volatile market in their index. And so again, as Steve said, those are not inconsistent. It could be still a market that's, quote, attractive today, but you have to hold on to your wallet because it is a very volatile market.
Just a quick, I don't want to speak for Steve, but I think the implication of what Steve was saying is the low valued land markets are risky in part because they attracted capital through mortgage markets as risky mortgage products.
Thank you, Ed, for taking
Got a few
my
more
question.
questions?
Yes, thank you.
Saw some over here. Yeah.
Typically, and I could be wrong, rental markets in the U.S. have been very fractionalized. I mean, you see large apartment buildings, but you don't typically have a single or a group of owners like Berkshire Hathaway or Blackstone that or BlackRock that are now coming into the rental market and buying like large swaths, or some of the REITs now are also concentrating ownership in the. I'm concerned that perhaps some kind of exogenous policy that in part because these sorts of enterprises that now are a presence in the ownership of in the rental market, perhaps exogenous policy like something that could come down from the G20 level would alter the degree of safety that renters can assume in terms of how does one call it, like the good faith relationship that typically, I mean, you pay your rent and you're not going to you get to enjoy a quality of life that is unmolested. It just concerns me that there's policy risks that could skew this because home ownership, again, was a degree of individualism. Renters didn't have to face concentrations by way of an ownership control in the rental market. I don't know, maybe this is just one of those new world order, what's the future like, very noir, and, what are renters at risk for?
Well, multifamily is the panel tomorrow, and so we'll leave that particular question for then. I don't. Any one last question? Anybody? Going once? Yes.
This is to the Germans. I don't know if there ever is a real housing bubble in Germany or has been, based on your slides. You seem to prevent that, but I guess if there was or something close to it, how would a valuer value that in brief terms? I mean, I know in America, typically it's a point estimate of value. You value whatever the most probable price is based on the most probable buyer, but I know you would do this differently. You wouldn't just go with this high wave of market based on what I know from your concepts.
I think that was one of the point which I mentioned last year in the presentation, that we do have also the mortgage lending value concept in Germany. We have on the one side the valuers or the appraisers is looking for the market value, and the market value is the value which is valid on this day. But on the other side, we have a mortgage lending value, which is a sustainable value, and there we are looking in the past, what was the development in the last 10, 15 years, and then we looked into the future and said, what do we expect it for this market for the next 5, 10 years? Do we expect some changes? And if yes, you have to think about how could this influence this trend, the prices? Might it go in a deep, sharp deep or not? And that is, I think, the different point. And the banks financed on the basis of the mortgage lending value. And if the mortgage lending value is a sustainable value, they don't finance the spot in the top market. Yeah.
Well, with that, we will adjourn for this evening. We'll reconvene in the morning for the panels tomorrow morning, and there's a reception in the lobby, and you've earned it. Thank you.